All right, let's just dive right in. MGM Resorts, they just dropped their Q3 earnings, and wow, Wall Street was not happy. So we're going to break down exactly what happened, what really spooked the market, and what this all means for the stock going forward.
And when I say not happy, I mean the market's verdict was swift, and it was brutal. The very next morning, the stock gapped down over 6%. I mean, that's a message from investors, right? It's loud and it's clear. They did not like what they heard on that call.
So, this is the big question, right? The one everyone's asking. How on earth does a company beat on revenue and still watch its stock get absolutely hammered? Well, that is the mystery we are digging into today.
Because here's the deal. The market, well, it saw right through that shiny headline number. It's kind of like they knew the real story, the one that actually matters, was buried a little deeper in the details of the report. Okay, let's just put the numbers on the board so you can see it for yourself. Revenue came in at $4.3 billion. And yeah, that did squeak by expectations. But that is not the story here. The real shocker, the thing that caused all the panic, was the bottom line. Adjusted earnings per share, just 24 cents. Now you got to remember, Wall Street was looking for 37 cents. That's not just a miss, folks. That is a huge miss.
Let me put a single number on that pain for you. It was a 35% negative surprise on earnings. 35%. In a market like this, you can't do that. A miss of that size is basically unforgivable, and it just screams that there are some serious problems under the hood.
So where did it all go wrong? Well, to really get it, you have to understand that MGM is basically living a double life right now. It's a tale of two completely different stories, and it all depends on where you look on the map.
And look, the difference between these two stories is it's staggering. So first, let's talk about the bad news, which is all coming from Las Vegas. You've got revenue down 7%, that key metric, revenue per available room, down 8%. Occupancy, down a painful 500 basis points. The Vegas Strip was a serious drag on the company. But then, you look over at Macau, and it's like a completely different universe. We're talking a record third quarter for earnings. They're growing their market share to over 15.5%, and they saw a 20% jump in winnings during that super important Golden Week holiday. Macau was just absolutely on fire.
And don't just take my word for it. Management faced this thing head on. The CEO, Bill Hornbuckle, he said this on the call, and I'm quoting him directly. "We heard from some of our guests around a value in Las Vegas, and we responded by making adjustments." Now, we all know what that is, right? That's CEO speak for, yeah, our customers told us things were getting way too expensive.
So what exactly was the problem in Vegas? Well, management basically described a perfect storm of bad luck. First off, you had this massive renovation project at the MGM Grand, which pretty much turned parts of it into a construction zone. Then the Spirit Airlines bankruptcy. That wiped out a key low-cost airline that their value-focused customers rely on. And on top of all that, they just saw fewer people driving in from Southern California, and that really hit their Luxor and Excalibur properties the hardest.
But okay, it wasn't all bad news for MGM. Not by a long shot. In fact, buried under all that gloom in Vegas, there's one part of their business that is just absolutely on fire. And it just hit a really critical turning point. I'm talking, of course, about BetMGM. Get this, they just raised their full year 2025 EBITDA forecast to around $200 million. That is a huge deal. Why? Because it shows this business is hitting profitability way, way faster than anyone on Wall Street thought was possible.
And you have to understand, this pivot is it's strategically profound. That $200 million guidance, that represents a nearly $450 million swing in earnings in just 1 year. But here's the kicker, the really crucial part. BetMGM is now going to start sending cash back to the parent company, MGM. They're starting with at least $100 million this quarter. So what does that mean? It means BetMGM is no longer a cash burn. It's officially a cash contributor, a money-making machine.
This quarter wasn't just about the numbers we saw. Management also made some really big, really aggressive moves to reshape the entire company. And in doing so, they're signaling exactly where they're placing their bets for the future.
They're basically running a three-part playbook here. Step 1 is sell. They sold off their Northfield Park operations for a cool $546 million. Step 2 is exit. They made a tough, but I think really disciplined call to pull out of the race for a New York casino license. And Step 3, fund. They locked down about $300 million in financing to push full steam ahead with their massive resort project over in Osaka, Japan. You see the pattern, right? It's a crystal clear pivot away from some of their mature assets and towards these huge, high-growth international opportunities.
And of course, with the stock getting hammered like this, you better believe management came out swinging on the valuation front. The CFO, Jonathan Hulkyard, he basically laid out the math for everyone. He argued that if you just apply a reasonable multiple to their properties using the price they just got for Northfield Park as a benchmark, the stock should be worth something like $60 a share. That's a pretty clear message, right? They think the market has it dead wrong.
Okay, so let's put all the pieces together. What does this all mean for the future of MGM? Let's break it down and give you our take, our rating on where this thing is headed.
All right, so looking ahead to next quarter, here's our prediction. You're going to hear management talk nonstop about stabilization in Vegas as those renovations finally wrap up. Macau, we expect that to just keep printing money. The big proof point for investors, though, is going to be seeing that first cash distribution from BetMGM actually happen. But the stock price? Well, it's probably going to be stuck in the mud for a while, at least until the market sees cold, hard proof that the Las Vegas engine is really and truly fixed.
And for all of those reasons, our official rating on the stock right now is underperform. Look, the long-term plan, it's definitely interesting, but the short-term damage to their core Las Vegas business is it's too severe to ignore. The market is firmly in show-me mode with this one.
So, with all that said, if you're an investor looking at this whole situation, there's a pretty interesting way you could think about playing it. We're looking at what's called a pairs trade. It's basically a strategy that lets you bet on the parts of MGM that are working great while hedging yourself against the stuff that's dragging the stock down.
So here's the talk ticker's pitch on this. On one side of the trade, you go long MGM Resorts. You do this to capture all that unique value we've been talking about, the incredible Macau strength, the new bet MGM cash flow, and yeah, that really beaten down valuation. But at the same time, you short a basket of other US-focused casino stocks, or maybe a gaming ETF. And the whole point of that short is to neutralize those sector-wide headwinds in Vegas. The thesis here is pretty simple. You're betting that the market is eventually going to wake up and reward MGM for its diversified growth engines, and that'll separate it from the rest of the struggling pack.
And of course, we always have to say it, this is not financial advice.